Hello and welcome to another episode of the Investor Financing Podcast. I'm your host, Beau, and today we're going to discuss a typical SBA 504 loan structure. So if you see on the screen, we're looking at a deal that's a $1 million total project cost deal. So there's two loans. There's a senior loan and then there's a junior loan. The senior loan is the bank piece. So we're able to finance 90% of total project costs for a business that is expanding, or they're building, or they're doing a rent replacement and building their own building. For a startup business, usually you're looking at 85% of total project costs being able to be financed. So we're going to finance 90% of total project costs, which are hard and soft costs. If it's land, if you're doing a construction loan, it could be the purchase of the land. Bear in mind that it's got to be entitled and you got to be shovel ready to close on your SBA loan. So on this $1 million of total project cost, we're going to finance essentially $900,000. And 50% of that is going to be the senior debt, which is the bank loan. And then the 504, or the SBA guaranteed piece, is the junior lien, which is 40% of the total loan proceeds, making up $900,000 collectively. So that's how these are structured. Now, during construction, the bank typically funds the senior and junior piece. Upon stabilization and certificate of occupancy, that's when the debenture happens. And then usually about 30 days from certificate of occupancy, the debenture happens, and that junior loan, or the second mortgage, converts to a 25-year fixed rate loan. So during construction, that's typically financed through the bank. They finance the first and second lien. Once you get certificate of occupancy, the debenture happens, and that's when the CDC essentially buys the loan from the bank.
You're listening to the Investor Financing Podcast. We'll be right back after this break.
Hi, this is Beau, host of the Investor Financing Podcast. I appreciate you checking out our channel. On this podcast, we talk about real estate, investing, financing, business lending, and acquiring and expanding your business. I'm sure you will find some videos here that will help you build your business empire. There's a lot to see. Take your time and make sure you comment, like, and subscribe. Thanks again. So that's how the mechanics work on these 504 loans. Now, some banks don't offer the junior piece. So there's actually lenders out there that specifically fund the interim construction portion of the second lien. So that throws a wrench in it. But most of the banks, non-bank lenders I work with, fund the A piece and B piece of the transaction. Anyway, I'm going to post some other SBA 504 videos that we have. We also have a playlist on the channel. I encourage you to go through them if you want to learn about SBA financing. It's an amazing tool. So the 504 is really for real estate type assets or heavy equipment, machinery, that kind of thing. And the 7A, although can be used for real estate, construction, and real estate and heavy equipment, the 7A can also fund a business acquisition and just intangible items or blue sky. So that's the difference between the 7A and the 504. The 7A has a little bit more flexibility. The 504 for real estate is usually superior rate and term. Anyway, hope you enjoyed this video on the typical 504 SBA loan structure. I look forward to having you on more of our shows, interviews. Please like and subscribe, and I'll see you on the next episode.